All right, good morning, ladies and gentlemen. Today is December 14th, 2022, and of course, it's Fed Day, as everybody knows, and the consensus expectation is for the Fed to hike 50 basis points. Um, Sorry I missed you last week. I actually had I had a plumber here for the past, geez, it seems like it was a 3 week ordeal, but had to have the kit or not the kitchen, the bathroom faucets replaced because they were leaking. And so when he started that job, um, ended up that pipes in the wall needed to be replaced and broke and that type of thing. And so anyway, it was a huge ordeal. You would think something as simple as having some bathroom faucets replaced would be like I thought it was going to be probably a half a day job, maybe all day. But they hadn't been replaced since the house was built, and so it turned into this huge ordeal where um, when he tried to undo the old pipes, something broke in the wall, and he had to cut behind the cabinet and get into the wall and fix that. And then he replaced all of the hardware. And then when he went to do the other side, same thing. Cut the water off, and the pipes in the wall are just so fragile. They're PVC pipes, and over the course of, a couple of decades, what happens is the glue, I guess, in those PVC pipes gets real brittle, and so if you even look at them, there's a water leak. And so it turned into this huge ordeal, and then he ended up having to cut a hole in the wall and the cabinet that was probably about 3 feet by 3 feet or whatever, and then fixing the wall was like a 2 day ordeal, just patching up the wall and repainting it and sanding it and all that. So anyway, last week and every day that he came to work over the course of that time, he would show up right at 10 o'clock, right? And he'd be carrying 5 trips of stuff up the steps to get in here and start his thing. So anyway, last week I was dealing with that, and thankfully last Thursday and Friday were the last days where he was able to patch up the wall and get everything back to normal. So it's all fixed, but it was an ordeal, as you can imagine, having someone working in the house. But so that's why I wasn't able to do a show last week. Like right at showtime, I had to let him in. So anyway, today, as I mentioned, is Fed Day, and today's probably the last hurrah for the market for the rest of the year. I mean, the last exciting thing. There might be some data coming out or something like that, but yesterday was a wild day, right? So the CPI number came out, and I did update my CPI chart here, and so you can see that there's yesterday's number. I found this somewhere on the internet a while back, and as you can see, I think it must have been over the summer. So there's July and August, and I was like, wow, this is kind of cool. I mean, everybody's seen graphs of the inflation rate and all that type of stuff, and obviously you can chart it, and there's plenty of places you can pull it up. But I hadn't seen it laid out like this in sort of a numerical fashion, which I don't know. Sometimes I look at a chart and it doesn't sort of sink in as much as actually seeing numbers like this. So I thought this was kind of cool, and I just saved it and decided what I would do is update it myself, right? Because I mean, inflation is the number one sort of thing that everybody's watching because everything revolves around the Fed's interest rate policy, especially the market. The market and I think everything's kind of a derivative of what's the prevailing interest rate, and that affects everything. And the even stranger thing is that interest rate adjustments take a while to work their way through the system, right? I mean, everybody knows that. They say that when the Fed adjusts interest rates, it takes 6 months to work its way through the system. And so we've had all these rate hikes this year. We had I'm trying to remember whether the first one was 25 or 50. So I think there was a 25 and a 50, and then three 75 basis points or 3/4 point or I'm sorry, 4 in a row. And then today, chances are that we're going to see 50 basis point rate hike. That is the expectation. Um, but it's not so much. I guess a surprise would be if they decided to only go 25, or if they decided to go 75. That would be the that might throw the market for kind of a wild ride today. But yesterday was crazy with the CPI release pre-market at 8:30. The futures, like, geez, they went up like 100 and I'm gonna say like 120, 130 points, like spiked up in 10 minutes, and then backed off like another 40 points, right? And that all happened in about 10 minutes, and then spent the rest of the day giving it all back, which was crazy. And I was not paying a whole lot of attention to the news about why the market gave it all back, but we're in a weird time of year. I always say that and I was alluding to that earlier. The last couple of weeks of the year are basically everyone's in coast mode. I think after today, most of the institutions are going to be done for the year with their positioning, and people are going to be taking a couple of weeks off and getting into holiday mode and all that type of thing. And so the market tends to be dull and erratic. Um, Overall, the decades that I've been doing this, typically at the end of the year, the small caps tend to be strong, right? Which is, haven't really paid much attention to small caps this year. We'll take a look at the different indexes, but first, the thing to note here is, and this is the consensus too, and I've seen lots of people posting data about the different things that affect inflation and how they're all decelerating, right? So there you go. The June inflation print marked the high, and as you can see, it's been coming down, decelerating. And of course, yeah, the price of gas too is has dropped considerably here, at least. When I drove by the gas pump yesterday, it was only 305, I believe, which which is kind of nice. I mean, I remember it was $1.99 at some point during the Trump administration. I think that was the lowest I ever saw, $1.99, and that was literally like for a couple of days, and it was back over $2. But and then it got to it got close to 5, and so seeing it right around $3 is, and of course I don't drive much. That's the irony of it, is that I really don't drive very much because I live in a small town and I work from home. So, but in the bigger scheme of things, the price of oil probably has one of the biggest effects, I would say, on just general price levels, because everything you buy at the store obviously has to get shipped in on trucks. Everything. So here's the thing is, 7% year over year inflation rate's terrible, right? Like back over here when it was accelerating, and it hit 7% a year ago, and it was going up. I mean, that was horrible news, and the Fed was panicking, and people were panicking, and food prices are going up at the grocery store. But what the crazy thing about this is, what most people, I won't say most people, but yeah, most people that don't follow the financial markets, they hear this sort of wordplay on the news, the traditional news, when they talk about inflation, when they're like, oh, good news, the inflation rate's coming down, this and that, or, inflation, they say inflation is coming down. They never say inflation rate. Like, you very seldom hear anyone use the word rate when it comes to inflation. So what they say is inflation's coming down, inflation, this and that, so, it's already peaked and coming. People expect prices to decrease, right? They think, oh, this is great, inflation peaked and it's coming back down, so pretty soon we'll go shopping and everything will be cheaper, right? But see, that's not the way that it works, right? Like if you look at this graph going back to 2013, I see let me think about this for a second. I see 1 month. I see 1 month in here with a negative, 0.1. Actually, there's a few here. I had to look to the right of this. So, back in 2015, you had a few months here where you had a negative number with inflation, meaning that there was no inflation, right? And so, but here's the thing: is inflation at 1 and 2%, it compounds annually, and so the rate of inflation means that if you start back here in 2013 and you say, okay, the rate of inflation, prices increased this much, year over year this month, and this much year over year this month, and this month, and you start adding this up and compounding it. See, that's the whole thing when you compound inflation. So basically, and everybody knows this, right, is the price of stuff that you buy goes up over your entire lifetime, right? I mean, everybody remembers the old, grandmother saying, "I remember when bread was a nickel, and now it's 2.79, 3.99." The bread that I like, a loaf of bread, the kind that I typically buy and like, is close to $4. It's like, 3.69 or 3.99, something like that. So, you know, loaf of bread a couple generations ago was a nickel. And so the point that I'm trying to make here is that this whole inflation debate, they act like when inflation comes down that prices are going to go down, but this like bout of inflation that we've had starting, the transitory inflation that really started taking off here around April and May of last year. These numbers, I mean, everyone's seen the price of stuff go up considerably. So if the inflation rate, theoretically was zero right here, um, the prices of everything are still going to be elevated, right? Like they raise the price of a certain item that you buy, and gradually it goes up here, and then a couple of months later it goes up again, and then it goes up again. You see this at the grocery store. Something was $1.79, then it's $1.99, and then it's, 2.19, 2.29, then it's 2.49, 2.69. And if it's something that you buy on a regular basis, then all of a sudden you're like, wow, this is 2.69, and I remember when it was, $1.79 or whatever. And then so when inflation goes back down, they don't lower the price of that. It just doesn't go up as fast, right? Like the next when inflation like finally, goes all the way back down to the 2% inflation goal of the Fed, that just means um, that they're not going to be raising prices as frequently and as much, right? So the funny thing is that once inflation like really kicked up last year, like sort of last fall, I guess, when these numbers started getting big here. That was the once inflation hits the news, and like they're talking about the news about inflation, and that's the all clear for every company out there to raise prices because they just blame it on inflation, right? They're like, oh, cool, we can raise the price of our stuff because everyone else is raising prices and prices are going up, and so and it's just they say that inflation is a monetary phenomena, and I mention this frequently about, and I don't know the exact stat, but something like, half of all the money, the U.S. dollars in existence, have been created in just the last, few years, or even, the last 5 years, say. But when you expand the monetary base, it waters down the purchasing power of the existing currency, and all you got to do is go to the Fed's Fred website and pull up the purchasing power of the dollar, and you'll see that the purchasing power of your Federal Reserve notes have been going down since the inception of the Federal Reserve in 1913. And then you zoom in on the chart, and look at like the year you were born, and then look at the purchasing power of the dollar since the year you were born, and then look at, the last 20 years, 10 years. And so that's just, it's just part of how the system is designed, is that the purchasing power of your money slowly but surely declines over periods of time, and everything ends up costing more. And it's like the proverbial boiling frog, right? Is as long as prices increase like really slowly over long periods of time and your purchasing power goes down, then there's no huge uproar about it because it's very gradual. And so everything is designed to be gradual. I mean, that's why the Fed didn't, when inflation got up here, around 8%. And obviously, this is the CPI, and if you believe the CPI, then because I'm sure all of us have seen certain things this year, over the past couple of years, where prices increased dramatically, and you're like, wait a minute, the inflation rate's only 7%. Why did you raise the price 15%? So, but anyway, enough about that. Oh, one last thing about speaking about inflation. So, interestingly enough, I was telling you the story about my plumber replacing the bathroom faucets, which look really good, by the way. So we have these gold faucets. The house was built with gold-colored faucets, which are difficult to find nowadays. Most faucets are stainless steel, or silver, whatever. So anyway, everything, all the fixtures in the bathroom are gold. So I went to Lowe's, Home Depot, Ace Hardware, and Amazon, and I pulled up every gold faucet available, right? And I was shocked. I was absolutely shocked. For one thing, they don't even make the kind that we originally had here. Faucets nowadays are kind of weird, but anyway, a brand name faucets, like bathroom faucets, or everybody's got a couple of bathrooms with the faucets. Wait till you go to replace those, right? Like there's Kohler, and there's another brand I can't think of offhand, but I mean they start at like $200 for two handles and a faucet. So I mean basically there's more than that. It's an assembly, but I mean you're talking like some of them were like $400. And then I thought to myself, well, geez, that's why that's if you were building a house and you were getting like a list of stuff that you needed to build a house or whatever. I mean, to me that was sticker shock. I couldn't believe that. And I'm sure that you could go to Walmart and probably buy like a cheap, silver faucet set or something for, not that much. But I mean, standard, um, just replacement faucets, just faucets in general, are insanely expensive. I was shocked because instantly I thought of, this is such a, nobody ever thinks about having to replace the faucets in their bathroom. Of course, one day you will if you're a homeowner and your house is 30 years old and the seals no longer seal up, and it leaks water out of the side. But anyway, besides all that, yeah, I was amazed. The ones that I wanted, I needed two of them. The ones I wanted were right around $200. So you're talking $400 in faucets, and that's before you hire a plumber to install them, right? And then if you're lucky, you're $800 into replacing a couple of leaky faucets, which seems crazy, but if you're like me, then it turns into a much bigger job. It was 6 days. He was here a total of 6 days replacing those faucets. Then you start tearing out walls and replacing PVC pipes, and then fixing the wall and that type of thing, and drilling and hammering and sawing. Man, it's something. But I was really shocked, and so now I think to myself, well, it's no wonder that home prices are so expensive, because all the things that go into them, the fixtures, the silly little stuff that you don't even think about. The prices of that kind of stuff have gone up a lot over the years, and so there you go. So, anyways, inflation compounds, right? And maybe it's headed back down to 5%. That would be great. So, you got to remember everything's compared year over year, right? So if you take this latest print here, so in 2022, theoretically, the average price of stuff that you buy was 7.1% higher than it was in 2021. But in 2021, it was 6.8% higher than it was in 2020, right? And then in 2020, prices hadn't gone up a whole lot since the previous November, but they went up a little bit. But anyways, these numbers, they compound. So if you take November year over year, and if you take $100 and then you add 1.3%, if you started right here and you add 1.3% to $100, and then you add 0.5%, this was a good year because prices were relatively stable, and then you add 1.7, and then you total it up, and then it goes up 2.2% and 2.2, and so you get down here, and then it wasn't too bad over this period of time, but prices increased year over year by this percentage, and so the prices had gone up, and then all of a sudden, boom, you take higher prices that are compounded, and then now, you say, wow, prices are up 6.8%. Now all of a sudden stuff's expensive, right? And then a year later, another 7.1% on top of all these small numbers that compounded. Now you're talking about serious price increases. And so, here's the thing about this is, if this number over the next 5 years starts coming back down, even if it gets down to around 2%, that means that the faucets that you need to replace, they didn't go down in price. They just they got really super expensive here, and then they may not go up as quickly or as much year over year going forward. So anyways, and that's assuming that inflation's under control at this point. And of course, higher interest rates affect everything. But enough about that. So, today's Fed day. When we get into holiday mode, the market tends to get really sort of dull. We're in the seasonally strongest part of the year, too, right? I was watching CNBC earlier before the show, and I saw Bob Pisani talking about how it's like 17 market strategists expect the market to be at 4,000 at the end of 2023. They expect no gain for next year, which seems kind of crazy, but I mean, it just seems kind of crazy, right? I mean, and I don't know, that's probably not the big firms that come out with their market predictions every year. Which, by the way, if you go back to I should have pulled this slide up. I have it somewhere. Last December around this time, all the big Wall Street firms come out with their, year-end forecasts for the following year, and basically all the year-end forecasts, they start at like 4,400 and go up to like, off the top of the chart. Several of them were over 5,000 on the S&P, because if you think about it, last December, let's look at last December. Here's where the market was last December, right? And so you were bouncing around between 4,500 and 4,800, the all-time high in the history of the world here. And so there's this thing called recency bias, and what that is basically, whatever the market's at now. Hang on a sec. Whatever the market's at now, people kind of extrapolate that, and so everybody assumed that the market was going to go up from there. There was a couple of firms that I think were thinking about the Fed raising rates and all this kind of stuff, and so they they had lower price targets. But anyway, I don't know what the exact numbers are, but I don't recall anyone saying that the S&P was going to be down 15% this year, right? And speaking of that, as of yesterday's close, the S&P down roughly 14%, right? From this all-time high here to over here, we're talking down 14%. The um, Nasdaq is down roughly 25%. So that's kind of that's a and the Dow's only down like 5%. So that's kind of interesting how the different indexes are. And at one point here, obviously, down at these lows, the S&P was down, 25, 28% roughly. So, I mean, when I go back and look at this chart, when I go back and look at the charts and the drawdowns for the year, I mean, I like to use the absolute low tick of the year. The high tick of the year, the highest high and the lowest low, just to get my range. If I change this into a line chart, you're not going to see that little poke at 3,500 there. So line charts are just going to, obviously show like the daily close, and so it'll be up for debate. What was the biggest drawdown of the year? But it's going to be roughly 25% on the S&P. Considerably more for the Nasdaq. S&P's recovered really well. The Dow, extremely resilient, which is kind of amazing. Before I forget, the thing to note here on this chart is yesterday's poke over this trend line. That's literally, the market's been in a downtrend, obviously, the entire year, right? And what is there after today? There's going to be, basically 2 weeks of trading left, but the last 2 weeks of the year are just kind of nothing, right? The market's probably going to get dead and this and that. And so you can't really go by what happens in the last couple weeks of the year. There might be some stocks that do great and some stocks that don't, and typically, like I said, small caps do good. The market tends to be pretty resilient towards the end of the year. But maybe it's because, maybe there's lower volume. I guess people that wanted to sell for tax loss purposes have already sold, that type of thing. And so at the end of the year, you just get, you get positioning, and maybe people putting some money to work, that type of thing. I don't know what the phenomena is, but I just know that we're in the seasonally strongest period of the year, for one thing, and it's going to be interesting to see how things play out. Back over here, I believe it was in September. Like if you look right around, this sell down here, Goldman Sachs lowered their year-end price target to 3,600, right when the market was right around 3,600, right? Because I mean, this sell down here from mid-August towards the end of September was pretty brutal, right? And it's just interesting because, I mean, if you're going to come out with a year-end price target like they do every year, these big Wall Street firms, you shouldn't, well, I shouldn't say you shouldn't be allowed to, but it's kind of silly that they do it in the first place with the idea that they're going to revise it as time goes along, right? So, I mean, what they do would be like me revising my year-end price target, to 4,000 today, right? And so, I mean, they come out, last year they come out with these numbers, 5,000, 5,200, all this crazy stuff. And then when the market, as the price sort of unfolds over the year, then they adjust their year-end price target. And so it's just kind of funny that, kind of ironic that, Goldman lowered their year-end price target to 3,600 when the price was right around 3,600, and then not that much longer, bottomed out and rallied back up here. But the thing about this chart is, and I've mentioned this before, the symmetry on these pullbacks and trend line touches. I mean, there's a lot of symmetry there. And notice like the first one, and kind of you guys know that I like to look at the space, the white space in between like the price, right? So instead of like focusing my eyes on the price, I'm looking at the white space here. Notice this little first dip of white space, like real shallow white space here, and then the big sort of, V looking part here. And notice the same thing here. The first, sort of dip and then the wider one where more time went by, and obviously there was a poke in the middle, but anyway, this whole first dip here and return to, in April here, this whole first dip and return to the trend line. The second one is very symmetrical to the first one, just in a bigger sort of, it's just a bigger version of the first one. This one's a little bit different. This is more of a, not really a V bottom, but it is kind of. It's a little bit of it went down. There was this little, poke up, like this little W here, but I mean it went down and then it went back up and hit that trend line. And so it's going to be really interesting. Here's the thing is the market right now is just waffling right on the 200-day moving average, which is declining. Um, Back over here, market broke above the 200-day moving average. It was within shouting distance of the all-time high, even after um, the war in Ukraine broke out, and that was a big part of this early sell-off in the year. And of course, the inflation and the Fed raising interest rates. So it was a rough start to the year. And then what I'm getting at here is this: the year of 2022, right? Because I might do a couple more shows this year, but starting to reflect back on the year. Basically, the whole year was, and this doesn't necessarily reflect the pain in the Nasdaq and a lot of the individual stocks and momentum type stocks and all that, which we'll talk about. But anyway, here's the point I want to make. There was basically like three significant rallies the whole year, right? The year had a down bias, and then there was, let me zoom it. Whoop, I didn't mean to zoom it like that. I meant to zoom it like this. Yeah, let's get that. So this rally right here from mid-March to April, April Fool's Day. What are we talking here? 2, 4, 6, 8, 10 days roughly from low to high. So there's a little 2-week rally right there, right? Boom, just kind of out of this pattern. And so, hey, I'm sure there was a lot of stocks that probably, bounced up and had big rallies, but it's a little 2-week rally. And so in order to participate in that rally, you would have had to, you would have, and like even right here, the first couple days of this rally off the lows here, this was just sort of what I'd call a dead. It was the first dead cat bounce of the year. And in theory, you wouldn't have really trusted this rally so much until it cleared these prior highs back over here, right? And so this one day here where it was sort of pinched in between the 50 and the 200 day there, right? Just on the underside. That was probably the day that you just said, okay, well, and quite frankly, if you went back and watched the tape, you'd probably find 50 people, 100 people on CNBC that came on and said, well, I think we've seen the lows, we've seen the lows here, the bad news priced in, blah, 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 whatever. But anyway, like right there was a little bit of steam left in the rally, and then that was it. And then, come April, you got that turn, and it was just brutal. Another leg down, some really big down days. This kind of price action is maddening right here. You see these days where and I could zoom in on that, but I'm not gonna move the chart too much. Yeah, you get like a huge up day, and then followed by a long range down day, and then you bounce around a little bit, and you get another big up day, followed by a couple big down days, and then you break down to new lows. And so those kind of days, everybody gets bullish, when you get a big long range day up, everybody gets bullish, and you had a potential double bottom there, right? So like over here, these couple of days, bull traps they call them. Anyway, so this was not real. This was not a tradable rally right there. I mean, you got a few days where you kind of bounced up, and then I remember this really well. This congestion area here, everyone was, and that was like 10 days. People marking the lows and highs and saying, well, it's gonna bust out of here, and I think I remember a lot of people sort of thought since we had this little sort of spike down low, we consolidated here, and since the move was up before the consolidation, the consensus, I believe, was that it was going to break to the upside, right? Because typically when you get a big move up and then a nice consolidation, the breakout is in the direction of, the prior move. But anyway, long story short, you can see what happened here, right? I believe this was primarily due to Fed hawkishness. Something happened there. Like, Powell said something, or, maybe it was a Fed announcement and he was really hawkish and talked about, something happened right there, but 3 days in a row just straight down to new lows. And quite frankly, that's all year long. Every time I see that, it's a reminder of how quickly the market can just all of a sudden, fall from 4,100 to 3,750 in 3 sessions like that. I mean, that was just absolutely brutal. That was one of the biggest and fastest sell-offs that I remember seeing in a long, long time. Those 3 days, just amazing. And you can see I mean, gap and go both of these days down. So anyway, after that, little panic capitulation down here at the lows, and then the next move up. And this was one of the strangest things that I've seen in a long time. The downward sloping trend line and the 200-day moving average literally converged right there, and everybody obviously was looking at that, and the fact that they ran the market up to there and then it reversed at that exact point was just, it almost seemed like one of these things where it's everybody expects it, and so you wouldn't in a million years think that, oh, well, they're going to rally the market all the way up to the downward sloping trend line and the 200-day moving average, and then it's going to reverse back down, because it was almost too obvious. And so, but that's exactly what happened, and so that was just strange, right? But I think my point was is that here was the second opportunity for buying some stocks and making a swing trade occurred in late July there. There was this big sell-off and then some zigging and zagging in these couple little spots here. And then, of course, you could draw and again, right above the 50-day moving average. Like, you could draw a horizontal line right there and say, okay, well, if the market, breaks out and clears this resistance here, then we could get a continuation. And so here you go, just under 4,000, and that little run up to the resistance there. That was, and that was a few weeks there, maybe a month. That was the second opportunity for some swing trades, some long swing trades, and perhaps in individual stocks. Now, of course, if you take the universe of stocks, think about the NASDAQ stocks. They had little bounces, but I mean, they don't. There's thousands of stocks that don't look anything like this. I mean, they just absolutely got decimated. Stocks down, 40, 50, 60, 70% and more. Anyway, you got that sell down, and so, same thing over here. Basically right here, just early November, like I should say, early to mid-November was basically the last sort of, theoretically opportunity, because I mean, unless, nobody was wanting to buy these panic lows, it seemed like anyway. And so over here, I mean, you were still vacillating around, being down between 20 and 25% on the year. And then, of course, same sort of thing. You got a little bit of a rally and then fell back in. And so there wasn't really an all clear until like right over here. And literally in like, one day, you went from down here to up here. And we're still like vacillating, right around 4,000 here. Right. And so, I mean, this last sort of leg was barely even an opportunity. So, pinpointing where one may have said, okay, I'm on the sidelines, but I'm going to go long, for the next 2 or 3 weeks on this chart would have been, it would have been very, very difficult. So, um, anyway, that's basically how the year, ended up there. Real quick, we can take a look at some of the other indexes in that, but it was a pretty tough year. And so an indexed portfolio, and by the way, this past year, I mean, as far as bonds go, interest rates went up and all this and that. It was like the worst year in 100 years for a 60-40 portfolio. So we can look at, let's see, we can look at TLT. Yeah, there we go. See, about got the whole year on there. 2022, 2023. Yeah. So, I mean, it's been a pretty nice bounce here, obviously, but the thing about bonds is that if you look at, if you got a bond that is at 100 and, that you paid 140 for and it's giving you, an interest rate or whatever, it's not supposed to lose value like this. I shouldn't say it's not supposed to. I mean, obviously, but anyway, looking at this chart here, and so, the bonds are what people buy for stability, right? Because in theory, your principal is not going to fluctuate dramatically. Well, worst year for bonds in ages, and of course that all depends, but basically this chart kind of spells it out. So there has been a little bit of a rebound here, but still pretty nasty. So the idea is that you buy bonds when interest rates are low, and I remember saying years ago when interest rates are zero, they got nowhere to go but up, and people are like, I mean, it kind of makes sense, but um, normal people, like non-financial people, would agree with that. You'd say, hey, if interest rates are basically zero, you know, they got nowhere to go but up, and normal people would agree with that. But financial types are like, oh well, no, I mean, interest rates are going to stay low forever, and that was kind of the perception, I think, because every time there's some sort of air quote crisis, which there's like, about 15 ongoing crises at any given time. But hey, we had the housing bubble burst and the financial crisis back in 2008. That was the financial crisis. And then we had the, and then of course the pandemic. That was the latest crisis. And so now when they talk about, pre-crisis levels, and I'm sure there was, a bunch of other crises in between those that I can't think of offhand. But the Fed likes to talk about returning the balance sheet to pre-crisis levels, and then you start to wonder which one they're talking about. Anyhow, it's been a weird year, and so it's been a very, very strange year. Real quick, NASDAQ 100, 400 down to, the 200s, now back up to 300. So the NASDAQ's down roughly, 25% on the year. And of course it could bounce up. It's got a little bit different behavior. Like notice the 200-day moving average. I don't have a trend line drawn on here, but if I did, just for the fun of it, there's a couple ways to draw a trend line. If you draw it like this, then this was like big fake out right there, right? And that kind of makes sense because like if you were in that period of time, if you go back in time and you would have everyone had their trend line drawn like that, and then so when you broke that trend line, there's probably a lot of people that thought, hey, here we go, sell-off's over, market's going back to new highs, this and that. Um, so anyway, it's kind of instructive to draw that trend line and realize, and the reason is that if the market breaks the trend line here, that doesn't necessarily mean that there's not another leg down. And so then you got this whole thing where everyone says that everyone else is bearish, and so they're bullish. A lot of these, I see these guys on CNBC, and they're like, well, everyone's too bearish on the new year, so we're bullish. And then the next guy's like, everyone else is too bearish, and so it's just kind of it's funny to see that. I remember years back, you'd see these guys, portfolio managers, strategists, they come on and say, well, the market can't go down because everyone, the sentiment is too negative, right? And so the sentiment's gotten too negative. And so the funny thing is that the sentiment gets negative when the market goes down, for a reason. And then the further the market goes down, the sentiment gets more negative. And so I guarantee that, that if the market breaks below the lows sometime in the coming quarters or whatever, the sentiment's going to be really negative because it's human nature. It's human nature to be bearish, after the market's been going down for a period of time. So, every single one of these declines, dozens of people will come on CNBC and say, as soon as you bounce a couple of days off of a low, everybody comes on CNBC and says, well, we think we've seen the lows here, blah, blah, blah. And so, I mean, there was people calling for the lows every single one of these sort of inflection points, right? And so all you got to do to call a low is wait for a couple of up days, right? After, you just wait for a couple of up days, or when you haven't seen a low in like a few days or something, or a week, and then you can say, well, we think the lows are in. It would be real easy right here to say, that 3,500, well, anyways, on the SPX anyways, it would be real easy to come on TV, especially now, that we've gone from 3,500 to 4,000. It'd be real easy to come on TV and say, well, we think we've seen the lows, this and that. So, and that's how it's gone sort of all year. Nobody has any clue, had much of a clue what was going to happen. And so it goes back to what I was saying before, the market, when the market had this sell-off here and hit new lows, that's when Goldman Sachs lowered their price target for, year-end price target to 3,600. So that's exactly how Wall Street works, is that they lower the price target after a big decline. So anyhow, I could keep going, but obviously I've got several people trying to reach me on my cell phone, so I need to wrap this up. Thanks for tuning in. I'll be doing shows for the next couple of weeks, providing nothing out of the ordinary pops up. So thanks for tuning in. We'll dig more